Welcome back to Portfolio, everyone. And in this video, we're going over 4 high growth ETFs you can buy today if you're looking for some fast capital appreciation over the long term. So in this video, we're going to take a look at 4 different ETFs that hold various different companies in different sectors of the market. And these are fast growing, high growth oriented ETFs that really don't pay out much dividends. So if you're looking for some capital appreciation and some nice total long-term reward, these are some ETFs you may want to take a look at. We have a combination of some low expense ratio, more index-based ETFs, and we also have some actively managed funds that have a little bit of a higher expense ratio. So we have lots of variances on this list today, and we're going to go over 4 high growth ETFs you can buy today if you don't feel comfortable purchasing individual stocks, if you want to get into a nice basket of companies or an ETF to kind of diversify your investment. We're going to go over 4 different options for you that you can always do some research into, take a look at, and may even add to your portfolio. So thank you for watching, everyone. I am the Gen Z Investor, and every single day on this channel, we talk about different stocks you can buy, overall stock market performance, and any other big stock market news and headlines. And ETFs are a great way for beginners to get started, or for people who don't feel comfortable just yet picking individual companies or can't really determine which companies are better than others to invest in. Low-cost ETFs give you great variety, great diversity, and for someone who doesn't know what they're doing, can be a great form of investing. So we're going to go over 4 different super high growth ETFs that have performed very nicely over the past 12 months. And we're going to take a look at their historical performance, take a look at the top holdings within that ETF, and go over some key facts of each fund. So the first one we're going to take a look at is a Vanguard fund, ticker symbol VGT, which is Vanguard's Information Technology ETF. Currently around $313 a share. Most brokerages right now offer fractional shares, so you can contribute as much money as you want into this ETF if you don't have enough to purchase one full share of over $300. Over the past 12 months, these shares are up 46%. And if we take a look, they do pay out a dividend of yield of only 0.86%, so a very low dividend yield. Like I mentioned, these are high growth, so with these ETFs, we're looking for more share price appreciation rather than capital or income coming into your portfolio. So these are lower yielding, much higher growth type ETFs. So dividend yield below 1% at 0.86, and on the 52-week range, you can see they are trading very close towards that 52-week high. A longer-term perspective, up over 213% over the past 5 years. So this is, of course, an information technology ETF, so it does hold a majority of tech companies. And this is a very attractive ETF for most investors who want exposure to that sector of the market because of the such low expense ratio. 0.1% expense ratio. That is extremely minimal, very low, where that expense ratio will barely eat into your total return. So of course, Vanguard is known for having some of the lowest expense ratios on the market. And for a high growth ETF like VGT, paying that expense ratio of 0.1 is great because that is extremely minimal. If we take a hypothetical growth, if you invested $10,000 into this fund 10 years ago, your money would multiply year over year and see this rapid growth. And in 10 years, your $10,000 investment has grown to over $74,000, which is absolutely incredible. If we take a look at their top holdings, although this is an information technology ETF, the holdings are divided into other subcategories or sectors within that specific industry. You can take a look here. They have some application software, some data processing, semiconductors, system softwares, and technology and hardware. And the top holdings are Apple, Microsoft, Visa, MasterCard, NVIDIA, PayPal, Adobe, Intel, Cisco, and Salesforce. So of course, these are some of the most well-known tech companies in the world that have all done very well over the past 12 months. And there's top 10 makes about 60% of this ETF. If you take a look, this total fund has around 328 stocks with assets of over $38 billion. That was the first one. If we take a look at their performance, you can see here they're averaging since inception about a 13% annual growth. And over the past 10 years, we've seen a nice bull run, their average return over 10 years is over 22%, which is absolutely incredible. Moving on to number 2, the second high growth ETF you can take your eyes on is ticker symbol ARKK, ARK Innovation ETF. So this is an ETF that invests in disruptive technologies. They want to invest in some of the most innovative companies that are going to change the way we live our daily lives. currently being valued at $87 a share, up 100% in the past 12 months. 1 year ago, shares were being traded around $44, rapid increase of over 100% in the past 12 months to around $87 a share. They have seen a slight sell-off over the past month. You can see somewhat of a decline because the overall market has, of course, fallen, which might make this a nice buying opportunity. Their 52-week high sits around $99 a share and currently being valued at $87. If we take a look at what this fund holds, they invest primarily in disruptive innovation. So they want to invest in companies who are working towards finding ways to change how we live our lives and impact people all around the world. This is an actively managed fund. This is not just an index ETF. You see here, ARK is actively managed that seeks long-term growth of capital by investing at least 65% of its assets in domestic and foreign equities of companies that are relevant to the fund's investment theme of disruptive innovation. So they really want to focus on investing a majority of their money in companies that are trying to change the world. So because this is an actively managed ETF, you are paying for that. So the expense ratio is somewhat high at 0.75%. But overall, when you compare it to some other highly active managed funds, you can get funds that are actively managed ranging around 2% of expense ratio, which is absolutely incredible. Like, that is insanely high that I would personally never invest in. So this expense ratio of 0.75, I'm going to say, is in the middle between the low end and the high end for expenses on an ETF. If we take a look, when you're getting this fund, of course, we saw that 100% growth in the past 12 months. You can see here, since inception, this fund is averaging 26% annual growth, which is incredible. Over the past 5 years, they've averaged around 29%. Absolutely incredible. And of course, so their largest holding in this ETF is Tesla, making up close to 10%. Invitae, Square, Roku, Crisp, Proto Labs, 2U, Illumina, Zillow, and LendingTree round out the top 10. So you can see here, a majority of this ETF is held within the top 10 holdings, and these are some of the most innovative companies. Of course, we know Tesla, which has been on a massive run-up, Square as well, all growing at a very fast rate. So this is ticker symbol ARKK. So this is ARK's Innovation ETF, another high growth ETF that you may be looking for right now if you want to get rid of some dividend income and you want to focus more primarily on growth. Third ETF we're going to take a look at for rapid growth is ticker symbol OGIG, O Shares Global Internet Giant ETF. So this invests in funds not only within the United States. This is a global internet ETF, so some of the best and brightest internet companies all across the world. Currently being traded around $43 a share, this fund is up 76% over the past 12 months, which is insane. Assets under management of only $394 million, so this is a smaller fund, but overall rapid growth of over 76% in the last year. And if we take a look, this fund invests in, like I mentioned, global internet giants, so some of the world's largest internet companies. If we take a look, they have an expense ratio of 0.48%, so not as expensive as ARK's Innovation ETF, and of course, nowhere near as cheap as Vanguard's Information Technology ETF. So once again, another ETF that is kind of actively managed and trading within the middle with regard to expense ratio. If we take a look at their holdings, their top 10 holdings, very normal. When you think about internet giants, nothing too shocking here. Their largest holdings, Alibaba, Amazon, Tencent, Google, Microsoft, Facebook, a couple of Chinese companies that I cannot pronounce, Zoom, Shopify, and Odoo, I don't even know. So very well diversified in a couple different sectors of the market. You have some Canadian, American, Chinese, different tech companies. Of course, this fund is kind of the maxed weighting. So you can see the largest individual stocks only make up around 6% of the overall fund. This is a complete internet-based fund. It's the internet giants. Of course, the internet has continued to grow. And of course, these companies have all put up massive returns over the past year. So if you're looking for a fund that focuses toward more internet-based stocks, and you believe the internet and the websites on the internet are only going to grow long into the future, then this is one you may want to take a look at. The final ETF on our list today, another rapidly growing high growth ETF, is First Trust NASDAQ Cybersecurity ETF. Up 22% over the past year, currently around $34 a share, with assets of over $2 billion under management. So this is a dividend paying ETF with only a 0.34% dividend yield. So another ETF with their dividend yield extremely minimal, almost non-existent. So of course, like I've mentioned many times, these ETFs are focused on long-term capital appreciation. Over the past 5 years, this ETF is up 100%, long-term consistent growth year over year. If we take a look at what this fund invests in, so this is a cybersecurity ETF. So of course, with the growing world of internet, we need more cybersecurity companies. People spend more time online, they put more of their private information on the internet, and the need and the demand for strong cybersecurity has only been growing rapidly. Not only for individuals, but companies as a whole are now transitioning a lot of their businesses and a lot of their business services to the internet. So they really need to focus and they really need to employ strong cybersecurity skills, and that's where these firms within the ETF are focused. Has an expense ratio of 0.6%, so once again, for an actively managed ETF, somewhat in the middle. Nothing too high, nothing too crazy, around 2%, but of course, nowhere near as low as a Vanguard Index ETF, which currently has a 0.1% expense ratio. Some of the top holdings: CrowdStrike, Broadcom, Splunk, Okta, Cisco, Skeller, Cloudflare, Checkpoint, BAE Systems, Booz Allen Hamilton Holdings. So once again, the largest holding only makes up around 8%. Nice diversified ETF, all within the cybersecurity industry. And within the actual industry breakdown, you have software and IT services making up the 2 largest chunks of the ETF. Communication equipment and semiconductors also make up significant portions as well. This fund has performed exceptionally well as well. This fund actually does outperform the index. You can see here that since inception, the fund has returned around 13% average. Over the past 5 years, it's around 13.2. And over the past 3 years, we've actually seen a boom in cybersecurity, and they are returning over 19% annually over the past 3 years. So another high growth ETF, of course, an extremely low dividend payout ratio, not really focused on dividend yields with any of these ETFs. These ETFs are solely for long-term capital appreciation, investing in companies where the companies itself that are held within the ETF are high growth tech stocks that usually don't pay out a dividend. So these companies are more high growth, looking for long-term capital growth in high growth industries that are very disruptive and innovating year over year. So those are 4 high growth ETFs you can take a look at right now if you're focused on some more capital appreciation rather than dividend income. Thank you for tuning in, everyone, and I'll see you in tomorrow's video.